This week, the market went up, but, not for the reason most people think. If you just looked at the headlines, you'd be forgiven for thinking that a year-end rally is a sure thing. But the truth is, this week's rally wasn't what it looked like. Let's break down what's really going on.
Okay, so this is the contradiction that really tells the whole story. On one hand, this week, the tech-heavy Nasdaq shot up almost 5%. I mean, that's a fantastic week, right? But if you just zoom out a little bit, for the entire month of November, the Nasdaq was actually down over 1.5%. This is the tension we have to understand. A big wave of short-term optimism washing over a much deeper, more uncertain current.
All right, so to really get what's happening, let's start with the surface story, the one that everybody saw. On paper, it was a great week for the market, driven by a lot of renewed optimism as we head into the final month of the year. And I mean, just look at these numbers. It was pretty much across the board. All three major indexes put up really strong weekly gains, and you could just feel the sentiment shifting. All that talk about a Santa Claus rally? Yeah, it was back and in a big way.
But a rally like this doesn't just happen. It's not magic. It was really fueled by three distinct, pretty powerful forces that all came together at once. If we want to see the bigger picture, we've got to understand these drivers. So let's get into it.
Okay, so first up, hopes for a Fed rate cut. Investors started feeling a lot more confident that we might see a rate cut in December, and that always gets the market excited. Then you had this huge news about Intel, the idea that they might be supplying chips for Apple. That sent their stock flying over 10%, and it just lifted the entire tech sector with it. And finally, number 3, holiday shopping. With Black Friday kicking things off, there was a lot of optimism around consumer spending, and that gave a nice boost to retail stocks. You put those three things together, that's your recipe for a big weekly rally.
So, yeah, everything looks great, right? But this is where the story takes a turn. Because while that rally felt really good and the headlines were all positive, the market was sending out some other signals, much quieter signals.
Yeah, these weren't the kind of things that make the front page. They were, well, quiet warnings. The kind of stuff that we, as long-term investors, have to pay attention to, because they're the things that really tell you what's going on under the hood. So let's dive into these two warnings. Think of them as those heavy currents moving just under that big, flashy wave of optimism. And believe me, they tell a very different story. All right, warning number 1 is what we can call an AI valuation correction. Remember that negative 1.5% number for the Nasdaq for the month? Well, this is why. It's because investors are starting to look at the crazy high prices of some AI stocks, and they're starting to ask, hey, has the hype gotten a little too far ahead of the actual business here? And actually, there's this narrative starting to pop up that compares the AI hype today to what people are calling the Cisco 2000 pattern. If you remember, back in the dot-com bubble, Cisco is a fantastic company. I mean, truly revolutionary. But the stock got so overvalued that it just collapsed. And that's the key lesson, isn't it? A great company isn't always a great investment if you pay too much for it. The second quiet warning was a little more technical. The CME group, the place that handles futures trading, had a system go down. Turns out it was a cooling issue at a data center. Now look, the impact was pretty minimal this time, but it's a huge reminder of just how fragile the plumbing of our market really is. All this high-speed, complex stuff is built on infrastructure that can fail. It's a risk that's always there in the background, right until it's suddenly in the foreground. Okay, so let's put it all together. You've got the big, optimistic rally on the surface, and then you've got these two quiet warnings underneath. And when you see both, you start to get the real story for the end of the year. And it all comes down to a shift from expectation to verification. And this is the really crucial part. The market is basically moving from one phase to another. For a long time now, we've been in what you could call the expectations phase, investing in the promise of AI. But now, we're shifting into the verification phase. The market's starting to say, okay, show me the money. It wants to see real, measurable ROI for all that investment. Just talking about the promise isn't going to cut it anymore. I think this is really the best way to look at it. The rally this week, that was the big splash. It was loud, it was visible, it got all the headlines. But for us, for the long-term investor, it's the current underneath, that shift from hope to proof. That's what really matters. It's way more important than the splash. So what does this all mean for us? What's the strategy here? Well, it kind of boils down to 3 things. First, pretty simple. Don't just chase the price. Second, really dig in and analyze the quality of the trend. Is everything moving up, or is it just a couple of big names dragging the market along? And maybe the most important question of all, is this rally for real? Is it backed by actual business fundamentals, or is it just sentiment?
Okay, so with that framework, what are we watching for as we close out the year? Well, we're about to see a few moments where the market's big expectations are going to run head-on into cold, hard data. Keep an eye on three things. On December 2nd, we get the ISM manufacturing report. That's our check on the real economy. Then, December 6th is the big one, the November labor report. That's going to be huge for what the Fed does next. And then all month long, we'll be getting holiday sales numbers, which will tell us just how strong the consumer really is. These reports, they're either going to back up all this optimism, or they're going to force a pretty serious reality check.
Which brings us to the big takeaway here, the real structural meaning behind all the noise and all the weekly moves. You see, the real story of this year-end rally, it isn't just about is the price going up? It's about something much deeper. It's about whether this is the moment the market finally decides to trade on proof instead of hope. Is the market ready to accept the reality that the data is about to show us, whether it's good or bad? That right there is the real test. If you want to go even deeper on the structural analysis behind these themes, we have our full note available. And for anyone who wants to understand the market quietly, structurally, day by day, you can follow us on X. Thanks for tuning in.